All right, let's talk about something really interesting that's happening right now in the financial markets. It's a genuine puzzle, and it's all about one of Australia's biggest companies, Commonwealth Bank. There's a really strange signal flashing, and, we're going to follow the clues and see what's actually going on here.
So let's start with this quote because it just cuts right to the heart of the mystery. Something in the numbers is sending a very loud signal. It's a warning that things aren't quite what they seem. And frankly, it's the kind of thing that makes people who do this for a living sit up and really pay attention.
And here we go. This is our first big clue. This chart shows what's called the spread. It's basically the difference between the dividend you get from owning CBA stock and the return you'd get from a super safe 10-year government bond. And that gap, well, it has blown out to a generational high. We haven't seen a level like this in more than 20 years. That is not normal. It's a huge signal, and it begs the question, why?
That yield spread is really just a symptom of a much, much bigger story. It's a story we're calling the Great Disconnect. And this is the real mystery we're trying to solve. There's this massive, widening split between how Commonwealth Bank is actually doing as a business and how the stock market thinks it's doing.
So, on one side of this paradox, you have the stock price. I mean, look at it. CBA's shares have been on an incredible run. They're trading just a tiny bit away from their all-time record highs. To look at this, you'd think the bank is doing better than it ever has.
But, and this is a really big but, this is where it gets strange. The price is telling you one thing, but the bank's actual business performance, it's telling the complete opposite story. You've got the valuation, what people are willing to pay, at multi-decade highs. Meanwhile, the core fundamentals, how the business is actually doing, are at multi-decade lows. So, how can both of these things be true at the same time?
To solve this, we kind of have to act like financial detectives, right? So let's start with our first piece of evidence, the bank's fundamental health. Let's go ahead and take a look at its report card. So when we say fundamentals, what we're really talking about are the key numbers that measure how healthy a bank's business actually is. Things like its net interest margin, that's its core profit on lending, or its return on assets and equity, which tell us how well it's using its money. These numbers, they don't lie. And this chart, wow, it shows exactly what's been happening to the business itself. For the past 20 years, CBA's core profitability metrics have been in a clear, consistent decline. The bank is just fundamentally making less profit and is less efficient than it was years ago. The trend here is absolutely undeniable. Okay, so we've established that the underlying business is getting weaker. Now let's look at the conflicting evidence. Let's move on to clue number 2, the valuation. In other words, how much are investors actually willing to pay for the stock? We measure this using something called valuation multiples, like the price to earnings or price to book ratio. You can almost think of these as a height meter. They tell us how much investors are willing to pay for every dollar of a company's earnings or assets. So a high multiple means expectations are very, very high.
Now compare this chart to the one we just saw, the fundamentals chart. It's practically a mirror image. While the bank's actual performance was going down, the price investors were willing to pay for that performance has shot straight up to the top of its historical range. I mean, this is the Great Disconnect, right here in living color.
So, what do we have? We have these two powerful forces just pulling in completely opposite directions, declining performance on one side, soaring valuation on the other. And that brings us to the climax of our investigation. What on earth does this all mean? Let's frame the question very directly. Just how far has the market's perception of CBA strayed from the reality of its performance? I mean, how big is this gap, really? Okay, this chart right here, this is the smoking gun. Historically, there's a really clear relationship. As the bank's profitability goes down, its valuation should also go down. It just makes sense. You can see all the old data points clustering right around that red trend line. But then, look at the latest data point, that black X. It's a massive outlier completely detached from 2 decades of history. The link has totally snapped. And just in case you thought that was a fluke, it's not. Here's another view, comparing a different performance metric to a different valuation metric, and we see the exact same pattern. The historical relationship is there, but that latest data point is way out on its own. The valuation seems totally unanchored from reality. So something has to give. The source material basically boils it all down to 3 possible solutions to our mystery. Possibility 1, the stock is actually severely undervalued. This idea leans on that huge dividend yield we saw at the start.
It suggests that, hey, compared to the tiny returns from bonds, CBA is a bargain, and its price should be even higher. Possibility 2, global bond yields are mispriced. Maybe CBA isn't the bargain. Maybe bonds are just crazy expensive, with artificially low returns that make everything else look good by comparison. Or, possibility 3, this massive disconnect is a warning sign. A sign that a major economic disruption, a macro dislocation, is just around the corner.
And that leaves us with one final, and I think pretty provocative question that really gets to the heart of this whole mystery. You have a massive tug of war between the story the price is telling you and the story the performance numbers are telling you. So when price and performance are in direct opposition like this, which one do you believe? Because eventually, one of them has to be proven right.